Santoli, let's talk a bit more about where stocks go from here. Dan Suzuki's with us, Richard Bernstein Advisors, Deputy CIO. How you doing, Dan? Good to see you.
Thanks, Carl. Good to see you, too.
You feel like we have our legs back or not?
I do think we have our legs back to some extent. I mean, I think that we do have to recognize that there has been some softness in some of the economic data recently. But the problem with the markets is it's a shoot first, ask questions later market. So the market tends to overreact, and some of the players in the market tend to over-exacerbate some of these moves. The reality is, yeah, the data is coming in a little soft, but at the same time, we also have to step back and recognize that the fundamental driver of markets is earnings, and earnings growth is not only accelerating, more importantly, it's broadening out by sector, by size, and globally. And I think that's some pretty good support for the markets outside of the normal type of volatility that we've just seen.
Right. Would you characterize the Q2 beats as interesting or material? And do you think that some of these revisions coming in a little shallower than we're used to is a good sign?
Yeah, I always think it's a good sign. I think that when you set the bar low, particularly for some areas of the market where, it's hard to imagine the bar getting any lower, I think you're really setting up for some positive surprises, especially with this sort of negative narrative around growth. In terms of sort of the earnings season, I think what's encouraging is that you are seeing the number of companies, the percentage of companies that are missing estimates. Remember, companies, no one, manages around missing estimates. So if they miss estimates, something's gone unforeseeably wrong. The percentage of companies where you're seeing that has gone down, despite sort of what people would call lackluster earnings season. I think that's an encouraging sign, and it suggests that this growth story, this earnings story, isn't falling off a cliff, which is part of the worry that I think the markets have.
Certainly. And one thing we were just talking with Mike Santoli about was the potential for another bout of volatility. Do you expect August 5th to essentially be kind of the short-term lows here, or do you think there will be additional drawdowns throughout the remainder of the year?
Yeah, Leslie, I don't know in terms of what the volatility picture is going to look like. I do think it's reasonable to expect that volatility is going to, come in fits and starts and be elevated this year. I mean, that's normal for an election year. That's normal for a period where big chunks of the market are seeing slowing earnings dynamics. That's normal for a year where, there's a lot of geopolitical events. But I think when you look past all that short-term volatility, I don't think there's a real reason to be worried about an imminent collapse. Now, we have to keep an eye on some of these leading indicators that are, potentially, starting to show some signs of weakness. But I think even in a scenario where those indicators are indicating some sort of recession in the future, we have to remember that outside of these shocks, these exogenous shocks, recessions take time, and it feels like death by 1,000 cuts. So the people that expect a recession is going to start tomorrow or 3 months from now, I think that's a bit too early. In the meantime, there's a lot of fundamental earnings support here.
There was a note over the weekend looking at basically the pillars that dictate consumer health, right? Employment, wealth, and credit. And I wonder, of the three, which would you pick to worry about first?
Well, I think they're all showing signs of weakness, Carl. And I think that's, part of that is really coming off of these, gangbuster levels that we saw post-pandemic, right? And so some of that, maybe 2/3 of that story of slowness is really a story of normalization off of unsustainable levels. Now, I would say that we've gone beyond that, and wage growth, jobs growth, hours worked, all those areas that drive total wealth and spending power are coming down, but we're still at pretty healthy levels. And I don't think there's any reason, when you combine that with balance sheets and confidence, to expect that that's going to collapse, in the next few months.
All right. We'll see how the Fed chair frames all of this in just a few days. Dan, really appreciate your time, especially on a week like this. Thanks.